Look at the Aussie dollar right now. Price is trading at 0.7071, perfectly glued to a pivot that has trapped both bulls and bears for the last 2 sessions. But there is one danger zone and one hidden opportunity right now. I'll show you both in the next 60 seconds. Do not close this video, because I'm giving you 3 exact levels you can trade today, including a setup that offers a risk-to-reward ratio above 1 to 3. Most retail traders are staring at the hourly buy signal and getting ready to pull the trigger long. They are about to walk straight into a trap laid by the daily trend. Stay to the end. I'll reveal the institutional flow that changes everything, and you'll walk away with a complete sniper plan, instant market verdict. I am calling the session bias a tactical bounce inside a structural downtrend. That means we are fading the daily sell but only against the best demand zones, not chasing the breakout. The single invalidation level that flips the entire structure is 0.7043, the S1 pivot support that aligns with the hourly moving average floor. Write this number down. If we break and close below 0.7043 today on the 4-hour candle, the entire relief rally is dead, and you can target the psychological 0.7000 handle and then the 200-day moving average at 0.6894. That would be a liquidation freefall that catches every week long. Now here is the micro insight. The herd is positioned net short on the daily downtrend, but the crowd is also loading up on fresh longs on the 1-hour and 5-hour strong buy signals. That means we have a perfect conflict zone. The smart money knows that the ADX on the daily chart is reading 33.8, which tells you the downtrend is strong and not exhausted. When you combine that with an hourly strong buy, what you get is a short squeeze setup that can rip through stops above 0.7083 and then fail viciously at the 20-period moving average resistance on the daily. I'll show you exactly where that trap sits. Let's go into the technical deep dive from the top down, because that's where the edge is. On the weekly chart, the trend is neutral, but we are hovering just below a key mean. The 50-week moving average near 0.7111 is acting like a massive ceiling. The monthly trend prints a strong buy signal, which is the long-term anchor, but the weekly neutrality tells you we are in a distribution phase. So the battleground is clear. Monthlies want higher, weeklies are undecided, and the daily chart is screaming sell. This multi-timeframe confusion is exactly where explosive moves are born. Come down to the daily. The daily trend is a confirmed sell. Price is trading below the MA20 at 0.7097 and below the MA50 at 0.7111. The 100-day moving average sits at 0.7037, just below the pivot, and that's providing a magnetic pull. The MACD is printing negative at minus 0.003 with a histogram that is still below the signal line. No bullish crossover yet. The RSI is 44.85, which is weak but not oversold. There is still room to fall. Williams percent R at minus 56.8 confirms the same mid-range bearish momentum. There is no hidden bullish divergence on the daily, yet. That is critical. This tells me that any bounce is a selling opportunity until we reclaim 0.7111 on a daily closing basis, now drop to the 4-hour chart. This is where the real game is played. Here's what most traders miss. The 4-hour is showing a clear positive divergence that hasn't confirmed. Price made a low near the 0.7022S2 support, and the oscillator tick higher, hinting that selling momentum is weakening. But the ADX on the 4-hour is still elevated, above 30, meaning the trend legs are intact. We are coiling between the pivot at 0.7062 and the R1 resistance at 0.7083. Every test of 0.7083 has been sold, and every dip to 0.7043 has been bought. This range compression is a pressure cooker. The 20-period moving average on the 4-hour is exactly 0.7066, and price is oscillating around it like a heartbeat. A convincing 4-hour close above 0.7083 would trigger a measured move to 0.7102 and then the 0.7123 R3 level. If we fail, the measured move downside is 0.7043, and a break of that opens the trapdoor to 0.7003 and the 0.7000 magnet on the 60-minute chart. The picture looks deceptively bullish. The MA5 is at 0.7063, the MA10 at 0.7073, and price is above both. We have a strong buy signal on the 1 hour, and the stochastic is at 50 but curling up. This is the lure. The retail trader sees a clean higher low and wants to buy the breakout. But look at the volume, it's thin. The whole move is being driven by an absence of sellers, not by aggressive buying. When the volume is missing, the breakout fails, and the reversal is brutal. That is the trap I flagged at the beginning. The 1 hour setup is a classic bull trap unless the daily structure confirms. And right now, the daily structure is your enemy if you're a bull. There's one more hidden danger. The Australian dollar to US dollar is the China proxy, and that linkage is screaming at us right now. Overnight, we saw Chinese industrial profit data print weaker than expected, and iron ore futures on the Dalian exchange slipped another 0.5%. Yet the Aussie dollar has barely budged. This divergence is a warning. The currency should be lower if the China risk proxy was working normally, but it's holding up. Why? Because the market is front-running a potential yuan fix that keeps the renminbi stable, and that is feeding a short-term short squeeze in Australian dollar to US dollar. But if iron ore continues to bleed and the yuan fix surprises to the downside, the Aussie gets a one-way ticket to 0.7000. So the fundamental driver over the next 1 to 2 weeks is this: the interplay between China's property sector fragility and the RBA's neutral hold. Policy divergence with the Fed is also a factor. US rates are sticky, and that yield differential keeps a lid on Australian dollar to US dollar. My directional lean is bearish for the next week unless we see a daily close above 0.7111. The event that invalidates that bearish lean is a Chinese fiscal stimulus headline that sends iron ore soaring, or a sudden weakening in the US dollar index below 104. Until then, rallies are sells, and here's the first interaction trigger. Do you think Australian dollar to US dollar tests 0.7000 this week? Comment yes or no right now, and drop your exact target. I'm tracking consensus, and I'll call out the herd in tomorrow's video if they're wrong. Now we move into the trade setup section. Most people skip this part. That's exactly where the money is made. Keep watching, because I'm going to hand you 3 precise trading plans, complete with stop losses and profit targets, that match 3 different risk profiles. Pay close attention to the on-screen graphics, screenshot them if you need to. Strategy 1 is the sniper, the conservative play for those who wait for confirmation and refuse to get chopped up. The trigger condition is a 4-hour candle close above 0.7085, meaning we need a clear break of the R1 resistance at 0.7083 with a buffer. We want confirmation that the squeeze is real and not just a wick. Stop loss goes at 0.7060, just below the pivot and below the 4-hour 20-period moving average, which is the level that would invalidate the breakout. Take profit 1 is 0.7102, the R2 resistance, and take profit 2 is 0.7123, the R3 resistance. The risk-to-reward ratio on this setup is 1 to 2.8, risking 25 pips to make 70 if both targets hit. What voids the setup entirely? A 4-hour close back below 0.7060 before we even reach target 1, or a daily close below 0.7043 while you're in the trade. If that happens, exit immediately. The sniper will show entry 0.7085 on 4H close above, stop loss 0.7060, take profit 1, 0.7102, take profit 2, 0.7123, risk, reward, 1:2.8R, invalidation, void if 4H candle closes below 0.7043 before strategy 2, here's your second interaction cliff. Type your Australian dollar to US dollar range for tomorrow in the comments now. Give me the high and the low, for example, 0.7060 to 0.7105. Let's see who's aligned with the smart money. Strategy 2 is the active trader, the standard play that exploits mean reversion and the daily trend's dominance. The entry condition is a sell on rejection at the 0.7095 zone. We are looking for price to tag the confluence of the daily MA20 near 0.7097 and the top of the 4-hour range, then show a bearish rejection candle like a shooting star or a strong bearish engulfing on the 1-hour chart. Enter on the break of the rejection candle's low, around 0.7092. Stop loss is placed at 0.7115, above the MA50 and the R2 resistance, giving the trade breathing room while respecting the weekly ceiling. The reasoning is simple. As long as we stay below 0.7111, the daily trend is your ally, and you sell into strength. Take profit 1 is 0.7060, the pivot area where short-term buyers will try to step in. Take profit 2 is 0.7045, just above the S1 support. For aggressive management, once target 1 is hit, move the stop to break even and trail by half the ATR, which is around 25 pips, 2. Capture a potential extension down to 0.7005. The risk to reward before trailing is 1 to 1.5, but it aligns with the higher probability trend. The active trader reads, entry, 0.7092, on 1H bearish candle break, stop loss, 0.7115, take profit 1, 0.7060, take profit 2, 0.7045, trailing stop after TP1, move to break even, trail 25 pips. Invalidation. Void if daily close above 0.7111. Strategy 3 is the aggressor, the high-risk counter-trend play for those who can lose small and manage risk aggressively. This setup is front-running the bounce from the support cluster before the herd piles in. Entry condition. A limit order at 0.7048, just above the S1 support at 0.7043, with a requirement that a 15-minute bullish pin bar or a double bottom structure forms exactly at that level. We are buying the first test of the demand zone, betting that the squeeze has one more leg before the trapdoor opens. The stop loss is tight at 0.7030, below the S2 support and below the weekly low, giving you only 18 pips of risk. Take profit 1 is 0.7078, right near the current price and the pivot point, and take profit 2 is 0.7095, the daily MA20 resistance. The risk-to-reward ratio on this is 1 to 2.6, but the probability is lower because you're fighting the daily trend. Explicit warning. This is only for those who can lose 18 pips without hesitation and are willing to see the trade stop out fast if the support breaks. The aggressor. Entry. 0.7048. Limit. 15M bullish. Structure. Stop loss. 0.7030. Take profit 1. 0.7078, take profit 2, 0.7095, risk, reward, 1:2.6R, invalidation, void if 1H candle closes below 0.7043, risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact Chinese data or Australian employment releases. Stops are non-negotiable. This is how you survive to trade the next big move. Now let's close the loop and prepare you for what comes next. The single most critical level for the next session is 0.7043. As long as that level holds, the bouncer's legs and the short squeeze can target 0.7102. If it breaks with volume, expect a rapid liquidation sweep to 0.7000 and then a test of the 200-day moving average at 0.6894. That is the level that separates winners from losers for the rest of the week. Tomorrow's wildcard is the Australian Wage Price Index data and any surprise yuan fix adjustment out of Beijing. Those events will be the spark that ignites the range. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen for the risk asset shadow analysis that ties directly into this Aussie trade. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Because the market never waits, and neither should you.